In a world driven by data and innovation, understanding the dynamics of market behavior has become essential for investors, traders, and anyone seeking to navigate the complex realm of finance. Technical tool analysis serves as a powerful tool in our arsenal, helping us make sense of the chaos and uncover hidden opportunities within the markets. As its core, technical analysis is the study of historical price and volume data to forecast future price movements. By analyzing charts, patterns, and various indicators, we can identify trends, support and resistance levels, and even potential turning points in the market. It allows us to gauge the psychology of market participants and make informed decisions based on probabilities. While fundamental analysis delves into the financial health of companies and their intrinsic value, technical analysis focuses on the collective actions of market participants and the impact on the price movements. It is based on the premise that history tends to repeat itself and that market trends can be identified and exploited for profit. Throughout this video, we will explore the key concepts from basics to multi-time frame analysis, market sentiment, candlestick patterns, support and resistance, technical tools and indicators, trading the news, etc. We will delve into chart patterns such as triangles, head and shoulders, double tops, double bottoms, etc. We will discuss popular indicators like moving average, RSI, and MACD and so on, which help us gauge market momentum and identify potential entry and exit points. Moreover, we will touch upon the importance of risk management and the role it plays in successful trading and investing. Technical analysis, when used in conjugation with proper risk management strategies, can significantly enhance our chances of success in the markets. However, it's important to note that technical analysis is not a crystal ball, it's not a foolproof, nor does it guarantee profits. Rather, it equips us with a set of tools and techniques to make more informed decisions and manage risk effectively. So, whether you are an experienced trader or just beginning your journey into the financial markets, this video will serve as a comprehensive guide to understanding and implementing technical analysis. By the end of it, you will have a solid foundation to start incorporating these techniques into your trading strategy. Welcome to my channel. Technical analysis has gained popularity in trading due to advanced charting packages and trading platforms. However, for novice traders, understanding technical analysis and its ability to predict market trends can be overwhelming. Technical analysis involves studying price movements and using historical chart patterns and indicators to forecast future trends. Traders analyze price action, indicators, and patterns to guide their trading decisions. It provides a visual representation of market performance and helps traders make informed choices before entering trades. First, let's understand what technical analysis is all about. At its core, technical analysis is the study of historical price and volume data to forecast future price movement. It is based on the belief that patterns repeat themselves and that market trends can be identified and exploited for profit. Traders interpret patterns on charts based on historic data such as price and volume. They identify trading opportunities by recognizing common market patterns. Indicators are applied to charts to determine entry and exit points, maximizing trade potential with favorable risk-reward ratios. While fundamental analysis focuses on economic factors, technical analysis, traders believe that past trends can predict future price movements. Combining both approaches can be beneficial for traders. So, what are the benefits of incorporating technical analysis in your trading strategies? Well, technical analysis offers several advantages. Firstly, it helps us identify trends, allowing us to align our trades with the prevailing market direction. By recognizing trends early on, we can position ourselves for potential profits. Secondly, technical analysis enables us to spot patterns that indicate potential market reversals or continuations. These patterns, such as triangles, head and shoulders, and double tops and double bottoms, provide valuable insights into the psychology of market participants. Lastly, technical analysis allows us to gauge market sentiment and momentum by utilizing indicators. These indicators, such as moving averages, RSI, MACD, help us make informed decisions by quantifying market conditions. Technical analysis aids traders in risk management and can be applied to any market and time frame. It can be used as a standalone method and helps identify market trends. Charts are essential in technical analysis as they represent price action, the fundamental measure of market performance. Different chart types such as line chart, bar charts, and candlestick charts are used to determine trends, whether uptrend, downtrend, or range-bound. Now, let's dive deeper into incorporating charts into technical analysis. Charts serve as visual representations of price movements over time, providing us with valuable information and insights. There are various types of charts available, including line charts, bar charts, and candlestick charts. Line charts offer a simple overview of price trends, while bar charts provide more detailed information such as opening, closing, high and low prices of a given period. However, candlestick charts are widely used for their ability to display price action in a visually appealing manner. Among the various chart types, let's focus on the top 3 charts commonly used for trading. These charts are constructed using the same price data but represents the information in distinct ways. Each chart type involves different types of technical analysis to assist traders in making informed decisions across various markets such as forex, stocks, indices, and commodities. Although there are several chart types available, we will focus on top 3 as they are commonly used and available on most trading platforms. Candlestick charts, with their distinct patterns and formations, allow us to identify market sentiments and potential reversals. Each candlestick consists of 4 main components: the open, high, low, and close. The body of the candlestick represents the price range between the open and close, while the wicks, also known as shadows, indicate the high and low prices during that period. Bullish candlesticks, typically represented in green or white, indicates that the closing price is higher than the opening price. They suggest buying pressure and potential upward movement in prices. On the other hand, bearish candlesticks, usually shown in red or black, signify that the closing price is lower than the opening price, indicating selling pressure and potential downward movement. Candlestick patterns are formed by the arrangement of multiple candlesticks and provide valuable insights into the market psychology and potential reversals. Patterns such as doji, hammer, engulfing, and shooting star are widely watched by traders for their predictive significance. Another key concept in technical analysis is support and resistance levels. These levels help traders identify areas where buying or selling pressure is likely to emerge. Support levels act as price floors where demand is strong enough to prevent prices from falling further. Resistance levels, on the other hand, act as price ceilings where selling pressure becomes dominant, preventing prices from rising further. Identifying and utilizing these levels can help traders make better decisions about entry, exit, and risk management. Bar charts, on the other hand, provide comprehensive information about price movements within a specified time period. Each bar on the chart represents a specific time period such as a day, week, or month. It consists of several key components: the opening price, closing price, high price, and low price. The vertical line, also known as the wick or shadow, represents the high and low prices during the given time period. The horizontal lines on the left and right side of the vertical line indicates the opening and closing prices respectively. Similar to candlestick charts, bar charts can also indicate bullish and bearish sentiment. A bullish bar occurs when the closing price is higher than the opening price, while a bearish bar forms when the closing price is lower than the opening price. Support and resistance levels, as mentioned earlier, are also significant when analyzing bar charts. These levels help traders identifying area of buying or selling pressure within the market. Lastly, line charts offer a simplified view of price trends, making them ideal for identifying long-term patterns. A line chart consists of a single line that connects the closing prices of an asset or instrument over a specified time period. Each data point represents the closing price, and when connected, they form a continuous line that visualizes the price movement. By observing the slope and direction of the line, traders can determine whether the market is in uptrend, downtrend, or sideways range. An upward sloping line indicates an uptrend characterized by higher highs and higher lows. Conversely, a downward sloping line suggests a downtrend with lower highs and lower lows. A flat or horizontal line represents a sideways or ranging market. Line charts also help traders identify important levels of support and resistance. These levels can be drawn as horizontal lines on the charts, indicating areas where the price tends to react or reverse. Additionally, trend lines can be drawn to connect consecutive highs or lows, providing insights into the strength and direction of the trend. When a price breaks above a downward trend line, it may indicate a potential bullish breakout. suggesting a reversal from a downtrend to an uptrend. Conversely, when a price bounces off an upward trend line and fails to break through, it may signal a bearish reversal or continuation of a downtrend. Line charts offer several advantages such as their simplicity and ability to show long-term trends clearly. They help traders grasp the overall market sentiment and make informed decisions. However, they may not provide detailed information about the intraday price fluctuations and can overlook crucial intra-period price action. Now that we understand the importance of charts, let's explore the utilization of indicators in technical analysis. Indicators are powerful tools that complement charts by quantifying market conditions. Traders use indicators to find trading opportunities in the market. Volume and price-based indicators help determine support and resistance levels, trend length, and breaches. Multiple time frame analysis allows traders to view price action from seconds to months, providing different perspectives. Moving averages, for instance, help us identify trends and potential entry or exit points. RSI and MACD provide insights into overbought or oversold conditions and market momentum respectively. Remember, in technical analysis, the trend is your friend. It's a well-known trading expression that has stood the test of time because trends play a crucial role in any trading plan. Trend lines are widely used in chart analysis due to their simplicity and usefulness. Trend trading offers a straightforward approach to compensate for strategy imperfections by identifying and capitalizing on the strongest trends in the market. Even if a trader enters a short trade during a temporary market rise, a strong dominant trend has the potential to turn a losing trade into a winning one, depending on the placement of the stop loss. Incorporating trend lines in trading allows traders to align themselves with the prevailing market direction, increasing the likelihood of profitable trades. To determine the trend, analyze a price chart containing approximately 100 to 200 candles. Assess the general direction in which prices are moving. When analyzing a chart, identifying an uptrend is relatively straightforward. You will observe a series of higher highs, which are peaks representing the highest points reached by the price, and lower lows, which are troughs representing the lowest point reached by the price during the uptrend as depicted in the provided chart. Uptrends indicate a bullish market sentiment where buyers dominate and drive prices higher. As the price continues to climb, it suggests a positive outlook for the asset or instrument being analyzed. It is important to note that all trends eventually come to an end. Therefore, this uptrend will transform into a downtrend when a series of lower highs and lower lows start to form. Lower highs indicate the declining peaks reached by the price, while lower lows represent the decreasing troughs. Connecting these lower highs with a trend line helps visualize and confirm the downtrend movement. It is worth noting that there are no strict rules for identifying highs and lows for trend analysis. The objective is to select the most evident instance of an uptrend or downtrend for trading purposes. During a range-bound market, the price oscillates between definite levels of support and resistance. Support is the lower boundary where buying pressure tends to prevent the price from declining further. Resistance is the upper boundary where selling pressure tends to prevent the price from rising further. Traders observe price patterns such as rectangles, triangles, or channels during a range-bound market. These patterns indicate the balance between the buying and selling forces, resulting in a lack of clear direction. However, it is important to be aware that range-bound markets can transition into trending markets. Breakouts or breakdowns occur when the price moves decisively above resistance or below support, indicating a potential trend continuation or reversal. Traders closely monitor price action and volume during a range-bound market to identify signs of potential breakout. Confirmation from other technical indicators and a surge in trading volume can strengthen the validity of a breakout signal. Traders should remain vigilant for a potential trend reversal. Trend lines are a fundamental tool in technical analysis, helping traders identify and visualize the direction and strength of the market trends. A trend line is a straight line drawn on a price chart connecting two or more significant price points such as highs or lows over a given time period. Trend lines serve two primary purposes. Firstly, they help traders identify the prevailing trend in the market. An upward is formed by connecting higher lows indicating rising prices, while a downtrend is formed by connecting lower highs indicating falling prices. Secondly, trend lines provide valuable insights into potential areas of support and resistance within the trend. In an uptrend, the trend line acts as support level while in downtrend, it serves as a resistance level. When drawing trend lines, it's important to consider the time frame and the relevance of the price points. Longer time frames tend to have more significant trend lines compared to shorter time frames. Trend lines can also act as dynamic support and resistance levels. If the price breaks above a downtrend trend line or below an uptrend trend line, it may signal a potential trend reversal or a breakout. It is worth noting that trend lines are not infallible and can be subjective to some degree. Different traders may draw trend lines slightly differently based on their interpretation of price action and market conditions. Remember to regularly reassess and adjust your trend lines as new price data emerges. Trends can evolve and change, requiring you to adapt your analysis accordingly. Understanding support and resistance levels is a vital aspect of technical analysis. By identifying these key price levels, you can enhance your trading decisions and manage risk effectively. Incorporating support and resistance analysis into your trading strategy allows you to identify potential entry and exit points, set appropriate stop loss levels, and spot potential trend reversals or breakouts. In our upcoming video, we will dive deeper into various types of support and resistance and techniques for identifying and using it effectively in your trading strategy. By understanding and incorporating these levels into your analysis, you can enhance your decision-making process and improve your trading outcomes. I hope you found this video helpful in understanding the basic concepts of fundamental analysis. If you have any questions or would like to share your experiences, feel free to leave a comment below. Remember, knowledge and practice are key to mastering technical analysis. Before we wrap up, I want to invite you to subscribe to our channel to stay updated with more valuable content on technical analysis and trading strategies. By subscribing, you will be notified whenever we release new video that can help you in your trading journey. Also, if you found this video helpful and informative, please give it a thumbs up and hit the like button. It helps us reach more traders like you and motivate us to create more educational content. Thank you for watching and best of luck in your trading endeavors.